Let me paint a picture for you. It's the beginning of 2026. The Fed has already cut rates 3 times. Inflation looked like it was finally cooling. Everyone, Wall Street analysts, crypto investors, regular people with savings accounts, was expecting one thing: more rate cuts in 2026. Lower rates, cheaper mortgages, more liquidity, more money flowing into the markets. That was the plan. And then something nobody fully saw coming happened. Energy prices spiked from the conflict in the Middle East. Inflation stopped falling, and instead of more cuts, the Federal Reserve just signaled that their next move might not be a cut at all. It might be a hike. On June 17th, just days ago, new Fed Chair Kevin Warsh held his first meeting. And what came out of that room changed the entire financial outlook for the rest of 2026. If you have savings, debts, a mortgage, a crypto, or investments of any kind, this decision affects you directly. And most people don't understand how yet. Well, that changes today. My name is Yang, and I track the moves that central banks, markets, and financial institutions make and translate what they actually mean for everyday people's money. If you want to understand not just what the Fed did, but what it means for your savings, your crypto, and your financial decisions right now, hit subscribe and give this a thumbs up if it helps. Here's the thing. Most financial news tells you what happened, very little of it tells you what to do about it. That's the gap this video fills. Let's break it down. So what actually happened on June 17th? First, what actually happened in plain language, no jargon, no noise. The Fed held rates at 3.5% to 3.75%. No change. That part was expected. 98% of traders predicted a hold going into this meeting. But it's what came with the hold that matters. The Fed released its dot plot. That's the chart where each Fed official anonymously marks where they think rates should be by year end. And look at what this June dot plot shows. 9 out of 18 officials now expect at least one rate hike before the end of 2026. Not a cut, a hike. And any rate cuts have been pushed to 2027 or 2028. For most of this year, the market was pricing in rate cuts. Now the market is pricing in a rate hike by October, with roughly 60% probability according to interest rate swaps. That is a complete reversal, and reversal of that size causes ripples across every single asset class. Savings accounts, mortgages, crypto, and stocks. Let's go through each one. What a rate hike means for your savings. Here's the good news first, because there is some. If you hold cash in a high-yield savings account, higher interest rates mean higher yields. Right now, the best high-yield savings accounts are paying around 3.25% to 4.10% APY. If the Fed raises rates by another 25 basis points, that number could tick up slightly. But here's what most people don't realize. The savings account yield bump is not the main story. It's a small win that gets completely overshadowed by 2 bigger problems. Problem number 1. Inflation is still running hot. The Fed's own projections put inflation at 3.6% PCE by the end of 2026. The April CPI print was 3.8% year over year. If your savings account pays 4.10% and inflation is running at 3.6%, your real return is less than 0.5%. You're not getting rich, you're barely staying even. Problem number 2, everything that's attached to rates gets more expensive. Mortgage rates are already at 6.53%. This is the highest they've been in months, up 14 basis points just this week. A 25 basis point hike from the Fed doesn't automatically push mortgage rates up by 25 basis points. The relationship is indirect, but it does push the floor higher. On a $400,000 mortgage, the difference between 6.53% and 7% is roughly $128 more per month. That's $1,536 per year, and over 30 years, $46,000 extra paid out of your pocket from less than a half-point rate change. If you're considering buying a home in the next 6 months, this is the number that should be driving your timeline decision. What a rate hike means for crypto. This is the section most of you have been waiting for, and I'm going to be direct because the data tells a very clear story. Bitcoin hit an all-time high of $126,000 in October 2025. It's now trading around $64,000, a nearly 50% decline from that peak. And here's what most people still haven't connected. That decline happened almost perfectly in line with the Fed stopping its rate cuts and markets starting to price in hikes. Here's the mechanism. It matters that you understand why, not just what. When interest rates are high, the US Treasury pays investors around 3.25% to 4.10% guaranteed return with almost zero risk. When you can earn 3.25% in a savings account or 4.10% in a treasury bill with zero volatility, the argument for holding a volatile asset like Bitcoin becomes harder to justify for institutional money. This is called opportunity cost, and right now, opportunity cost is running against crypto. We've seen this exact dynamic before. Look at 2022. The Fed raised rates by 525 basis points over 16 months. During that same period, Bitcoin lost over 65% of its value from its November 2021 peak. Now, here's where it gets really interesting because 2026 is not 2022. In 2022, there were no spot Bitcoin ETFs. Today, there are. Institutional investors, BlackRock, Fidelity, pension funds have created a structural demand floor under Bitcoin that didn't exist 3 years ago. A single 25 basis point hike in 2026 is not the same as 525 basis points of hikes over 16 months. The more accurate question is, if the hike comes, how much is already priced in? The answer, based on current market positioning, is quite a lot. Bitcoin has already dropped 50% from its high. The fear is already in the price. If the hike comes and is only 25 basis points and signals no further hikes, the market reaction may actually be relief, not panic. But the uncertainty between now and October is real, and that uncertainty is where volatility lives. Kevin Warsh is the new character nobody's talking about. Look, I have to spend 60 seconds in this because it matters more than people realize. Kevin Warsh is the new Fed chair. He replaced Jerome Powell in May 2026, and his first meeting sent signals that are different from anything the Powell era produced. He did 3 things that nobody else is fully explaining. Number 1, he refused to submit his own dot plot projection, making the Fed's rate path harder to predict. When the chair won't tell you where they're going, the market price is uncertain. Uncertainty costs risk assets. Number 2, he dramatically shortened the Fed's policy statement and removed all forward guidance language. The old Fed told you what they were planning to do. The new Fed gives you the facts and nothing else. That's a fundamentally different relationship between the central bank and the market. Number 3, he announced 5 task forces to overhaul how the Fed operates, measures inflation, and communicates policy. What this adds up to is simple. The Fed just became less predictable, and markets, crypto especially, price uncertainty before the price outcomes. Less predictability means more volatility, not necessarily more downside, just more movement. And here's what to actually do right now. Here's a practical section. 4 moves, not financial advice, just things worth understanding. Number 1, if you're holding adjustable rate debt, review it now. Credit card debt at 21% APR gets worse if rates rise. Adjustable rate mortgages or HELOCs tied to the prime rate move up automatically when the Fed hikes. If you have either of this, paying them down or locking into a fixed rate before October matters more now than it did 6 months ago. Number 2, lock in short-term treasury rates while they're still near 5%. 3-month and 6-month treasury bills are paying around 3.25% to 4.10% right now. If the Fed hikes once and then stops, those rates may actually come down in 2027. Locking in a 6-month or 12-month treasury note captures the current yield before any policy reversal. Number 3, don't panic, sell crypto, but size your positions honestly. If you're holding crypto on borrowed money on margin or with funds you need in the next 6 months, this is the moment to reassess that risk. If you're holding Bitcoin or Ethereum with a 3 to 5 year horizon and money you can afford to leave untouched, the 50% pullback from the ATH is already a significant reset. History suggests patience wins here, but the path between now and the Fed pivot is going to be noisy. Number 4, watch the October meeting more than any other date this year. This is CME Fed Watch. It shows real-time market probability of each Fed move. Bookmark this page. The October 28 to 29 FOMC meeting is the most consequential financial event of the rest of the 2026. Whatever happens there, rate hike, hold, or surprise, will move every asset class you care about. Here's the honest summary of where we stand. The Fed held rates at 3.5% to 3.75%. A new chair has taken over and removed the playbook. 9 officials think a hike is coming before year-end. Inflation is at 3.6% and rising. Bitcoin is down 50% from its peak. Mortgage rates are 6.53% and climbing. Is this a crisis? Of course not. Is this a moment that requires you to pay attention to things you might have ignored when rates were falling? Absolutely yes. The investors who do well through the rest of 2026 are not going to be the ones who reacted fastest. They're going to be the ones who understood the environment clearly and made calm decisions instead of emotional ones. You've just done the understanding part. The decisions are yours to make. If this video gave you clarity on something confusing, please hit the like button. It helps more people find this content instead of getting their information from panic headlines. Subscribe and hit the bell. I post every week on crypto, investing, and personal finance. When the October Fed meeting happens, I'll be here with a full breakdown the same day. Drop a comment below. Are you making any financial changes because of the Fed's June decision, or are you holding your current positions? I read every single one. See you in the next video. Bye!